I want to continue on a topic I brought up in a previous video, and that was about big scary market downturns. Now there was an article, it was entitled, "Why You Should Always Be Ready for a Big Scary Stock Market Sell-Off." And they gave some statistics in the article that I thought were really good. Number one, they said, only once in the last 89 years has the S&P 500, large US stocks, not dropped at least 4.4% from an interim peak. And in 2016, there were 4 of these occurrences, and market still rose 9.5%. In other words, it is very normal to have at least a 4.5% approximate drop in the stock market inside of a year. And they may be unnerving when you have that big of a drop in the market, but it's a fairly normal occurrence, and it's good to remember that. The other thing they said in the article was this: full 3/4 of the time, these intra-year corrections were 10% or more. So that's a pretty big downturn in the market 3/4 of the time, 3/4 of years. Now the average was 17%. That's a pretty big downturn. And they actually had this chart in the article that I thought was really good. And it was showing those graphically going back to 1928. Those actual downturns. So all the bar chart is, they're all going down, so that's showing the negative returns. And some of these intra-year downturns, 40, 50%, 30% wasn't unusual. So big downturns, and if I don't know that they might happen and I don't expect them, when they do happen, they cause me to panic and make really bad moves with my money. Now the question is this: can an investment manager, a professional, figure out when these things are going to happen? Well, if they could, then they would be getting returns that are in excess of the market. If you look at the past 5 years, ending in 2016, the percentage of large cap stock fund managers that outpace the market, it's the green. Not too good. Red is underperformance. Small cap managers, not any better, actually even worse. So if we look at various areas of the market, we see that these professionals aren't figuring out when these downturns are going to occur. So having them to look to for guidance is of no help. Now, to the point. Number one, downturns are to be expected, fairly normal, and they shouldn't be a source of concern. They can be, and often are, pretty large. And finally, volatility is your friend. You know, if it weren't for volatility of the market, we wouldn't have the higher returns of the stock market. If we look at things that aren't volatile, like fixed income investments, or when people say, you can't lose money in this and you can't have any negative returns in it, pretty much bet you won't have any real positive returns either. It's just a function of the way markets work. So, hope this helps out. We'll catch you next time.